There is a number circulating through the global financial system right now that does not make sense. $315 trillion. That is the combined debt of every nation, every corporation, and every household on this planet as of early 2024, according to the Institute of International Finance. 315 trillion. Stop and consider that figure. Global gross domestic product, the total value of every good produced and every service rendered by every human being on Earth in an entire year, is roughly $105 trillion. The world owes 3 times more than it produces. Every country is in debt. The United States owes over 36 trillion. China owes approximately 14 trillion in government debt alone, with corporate and household obligations pushing its total far beyond that. Japan's public debt exceeds 250% of its annual economic output. European nations collectively carry obligations in the tens of trillions. Emerging markets, from Brazil to South Africa to Indonesia, are drowning in dollar-denominated liabilities they can barely service. Here's the question that should keep you awake. If every country on Earth is a borrower, then who exactly is the lender? Where does this money come from? Who is sitting on the other side of $315 trillion in obligations, collecting interest? And why does no mainstream financial institution publicly address the mathematical impossibility of what this structure implies? This is not a rhetorical question. It is the entry point into a systemic anomaly that regulators either cannot explain or will not explain. The answer, as this analysis will demonstrate, reveals a financial architecture that is far more fragile, far more circular, and far more dependent on collective illusion than any official institution will admit on the record. The paradox first entered public discourse in a limited way during the aftermath of the 2008 financial crisis. Journalists covering the collapse of Lehman Brothers and the subsequent bailouts began asking a basic question. If the American government needed to borrow $700 billion for the Troubled Asset Relief Program, who was lending it? The answer was complex. Foreign governments, primarily China and Japan, were major holders of United States Treasury bonds. Domestic institutional investors, pension funds, insurance companies, mutual funds, held significant portions. But as investigators dug deeper, a circularity emerged. China was buying American debt with dollars earned from trade surpluses, dollars that only existed because the Federal Reserve had created them. Japan was financing American borrowing while simultaneously being the most indebted developed nation on Earth, carrying obligations exceeding 1 quadrillion yen. The money was not coming from some external vault of real savings. It was being generated within the system itself, lent within the system, owed within the system, and counted as an asset and a liability simultaneously by different parties within the same interconnected structure. The Institute of International Finance began tracking global debt systematically in 2012. Their quarterly reports became the closest thing the financial world has to a comprehensive balance sheet for the planet. By 2017, total global debt had crossed the 230 trillion mark. By 2020, fueled by pandemic-era stimulus, it exploded past 280 trillion. The trajectory has not reversed. It has accelerated. Each quarter, the Institute reports a new record. Each quarter, the gap between total debt and total economic output widens. And each quarter, the financial press treats the number as a curiosity rather than an emergency. The reason for this complacency is itself part of the anomaly. To understand why $315 trillion in global debt constitutes a paradox rather than merely a large number, you need to understand how sovereign debt is supposed to function. Think of it as a bridge. A government needs to build infrastructure, fund defense, maintain social programs. Tax revenue covers most of this, but not all. The gap is financed by issuing bonds, essentially writing formal promises to repay borrowed money with interest over a fixed period. Investors buy these bonds because they trust the government will honor its obligations. The bond market functions as a bridge between present needs and future revenue. In a healthy system, the bridge is temporary. You borrow to invest in something productive. That investment generates economic growth. The growth produces higher tax revenue. The higher revenue repays the debt. The bridge is crossed and the obligation is retired. The safeguards in this system are straightforward. Credit rating agencies evaluate whether a government can realistically repay what it borrows. Bond markets price risk through interest rates. The less trustworthy the borrower, the higher the rate demanded. Central banks manage currency stability to ensure that borrowed money retains its value. International institutions like the International Monetary Fund monitor fiscal sustainability and intervene when nations approach insolvency. This structure assumes a critical condition that debt is finite, purposeful, and repayable. Every mechanism in the system depends on this assumption. What happens when the assumption no longer holds is the subject of the anomalies that follow. The first anomaly is the circular lending structure itself. The United States borrows from Japan. Japan borrows from its own central bank, which creates yen to purchase government bonds. China lends to the United States while simultaneously borrowing domestically at an extraordinary scale through local government financing vehicles, opaque entities that have accumulated an estimated $9 trillion in debt that Beijing does not fully account for in its official figures. European nations borrow from the European Central Bank, which purchases their bonds through programs created during the sovereign debt crisis of 2011 and 12. Every major creditor is simultaneously a major debtor. In any normal accounting framework, when you owe money to someone who owes money to someone who owes money back to you, the net position should be close to zero. But in the global debt structure, every party books its lending as an asset, while every other party books its borrowing as a liability. The gross figure, $315 trillion, reflects this double counting. Yet no institution publishes a net figure. No regulator consolidates the global balance sheet to determine who, when all the circular flows are canceled out, actually owns the underlying wealth. This absence is not an oversight. It is structurally necessary. Because the net figure, if it were ever calculated honestly, would reveal that a significant portion of global debt is owed to entities that themselves have no real capital. Only other people's promises. The second anomaly is the role of central banks as lenders of last, first, and only resort. Since 2008, the combined balance sheets of the Federal Reserve, the European Central Bank, the Bank of Japan, the Bank of England, and the People's Bank of China have expanded from approximately $4 trillion to over $30 trillion. These institutions created money, not metaphorically but literally, through electronic entries in banking systems, and used that money to purchase government bonds, corporate bonds, and, in some cases, equity securities. The Bank of Japan now holds more than 50% of all outstanding Japanese government bonds. The European Central Bank holds approximately 30% of Eurozone sovereign debt. The Federal Reserve's holdings peaked at roughly one-third of the United States Treasury market. These central banks are not independent investors deploying capital they earned. They are monetary authorities manufacturing purchasing power and deploying it to ensure that their own governments can continue to borrow. In any corporate context, this would be identified as related party lending with no independent market validation. It would trigger immediate regulatory investigation. At the sovereign level, it is called monetary policy. The third anomaly concerns the shadow banking system. The Financial Stability Board, the international body that monitors global financial risks, estimated in its 2023 report that non-bank financial intermediation, commonly referred to as shadow banking, represents approximately $63 trillion in assets globally. These entities include hedge funds, private credit vehicles, money market funds, insurance-linked securities, and structured investment vehicles. They operate with significantly less regulatory oversight than traditional banks. They are not subject to the same capital requirements, stress testing, or disclosure obligations. Yet they are deeply interconnected with the traditional banking system through repurchase agreements, derivatives contracts, and collateral chains. When Archegos Capital Management collapsed in 2021, losing approximately $30 billion in a matter of days, the event revealed that major banks, Credit Suisse, Nomura, Morgan Stanley, had extended enormous leverage to a single family office with almost no visibility into its concentrated positions. Archegos was not unique. It was representative. The shadow banking system is where the comfortable fiction of global solvency meets the uncomfortable reality of unmonitored leverage. The fourth anomaly is the derivative superstructure. The Bank for International Settlements, often described as the central bank of central banks, reports that the notional value of outstanding derivatives contracts exceeds $600 trillion. This figure is roughly 6 times global gross domestic product. These contracts include interest rate swaps, currency forwards, credit default swaps, and exotic structured products. They are used by governments, banks, and corporations to hedge risk. In theory. In practice, a significant portion of derivative activity is speculative, generating paper obligations that multiply the underlying exposure many times over. The notional figure is not the same as actual risk exposure, but it represents the total value of contracts that must perform as promised for the system to function. If a counterparty defaults, if one major link in a derivative chain breaks, the cascading effect follows the same logic that destroyed American International Group in 2008, when a relatively small number of credit default swap contracts triggered a $200 billion government rescue. The derivative market today is orders of magnitude larger than it was in 2008. The counterparty risk is orders of magnitude more concentrated, and the regulatory framework is only marginally improved. The fifth anomaly is the absence of global accounting consolidation. Every nation publishes its own balance sheet. Every central bank publishes its own holdings. Every international institution publishes its own assessment. But no entity on Earth produces a consolidated global financial statement. There is no document that shows, in a single audited framework, who owes what to whom, what the net position is, and where the real vulnerabilities concentrate. The International Monetary Fund comes closest with its global financial stability reports. But these are analytical assessments, not audited accounts. They rely on self-reported data from member nations, data that is often incomplete, delayed, or constructed using national methodologies that are not comparable across borders. China's definition of government debt differs from America's. Europe's treatment of contingent liabilities differs from Japan's. The result is that the $315 trillion figure is simultaneously the most important number in global finance and the least reliable. It is an estimate built on estimates, calculated from self-reported data, with no independent verification, no standardized methodology, and no mechanism for enforcement if any participant underreports. The sixth anomaly is what might be called the creditor paradox. Traditional economics assumes that behind every liability there is a corresponding asset. Someone saved the money that was lent. But in the modern monetary system, the majority of money is created through the act of lending itself. When a commercial bank issues a mortgage, it does not withdraw savings from a vault. It creates a deposit in the borrower's account through a ledger entry. The money literally did not exist before the loan was made. The Bank of England published a landmark paper in 2014 titled "Money Creation in the Modern Economy" that explained this process clearly. At the sovereign level, the same mechanism operates through central bank bond purchases. The implication is profound. A significant portion of the $315 trillion in global debt is owed to money that was created specifically to fund that debt. The lender and the loan came into existence simultaneously. There is no external creditor sitting in a vault demanding repayment. The creditor, in many cases, is the system itself, a recursive loop where debt creates money, money buys debt, and the total grows without any external anchor to real economic value. Two interpretive frameworks exist for this structure. The first is benign. Modern monetary systems are fundamentally different from historical ones. Sovereign nations that borrow in their own currency cannot technically default because they can always create more currency to service their obligations. The circular nature of global debt is a feature, not a flaw. It provides flexibility, liquidity, and the ability to respond to crises rapidly. The expansion of central bank balance sheets since 2008 was necessary to prevent economic collapse, and the system has functioned adequately since. Inflation, while elevated in 2022 and 23, has been brought under relative control. Employment remains strong in most developed economies. The apocalyptic predictions have not materialized. The second framework is considerably darker. The system functions only as long as every participant maintains confidence in every other participant's willingness to continue the cycle. Japan can carry debt of 250% of gross domestic product only because the Bank of Japan is willing to monetize that debt indefinitely. The United States can run trillion-dollar annual deficits only because foreign central banks and domestic institutions continue to treat treasury bonds as risk-free assets. Europe can hold together only because the European Central Bank has signaled its willingness to intervene without limit. The entire structure depends not on solvency, but on perception. And perception, unlike mathematics, can shift overnight. The evidence for where the truth lies exists in specific traceable data. The Federal Reserve's reverse repurchase facility, a mechanism that allows financial institutions to park excess cash overnight with the central bank, peaked at over $2.25 trillion in 2022. This level of overnight parking suggests that institutions had enormous quantities of liquidity they did not trust to deploy in the market. Treasury auction data, published by the United States Department of the Treasury, shows the evolving composition of buyers. The ratio of direct bidders to indirect bidders to primary dealers reveals who is eager and who is reluctant. The International Monetary Fund's Currency Composition of Official Foreign Exchange Reserves database tracks the global shift in reserve holdings and shows a slow but measurable decline in the dollar's share from roughly 71% in 2001 to approximately 58% in 2023. Each data point alone is unremarkable. Together, they trace a pattern of gradual institutional disengagement from the assumption that current arrangements are permanent. The Federal Reserve monitors these figures in real time. The European Central Bank conducts stress tests that model sovereign default scenarios it cannot publicly discuss. The Bank for International Settlements publishes quarterly reports that contain, buried in technical language, warnings about derivative exposure and cross-border contagion risk that would alarm any informed reader. The International Monetary Fund has developed an internal framework for sovereign debt restructuring, a framework you do not build unless you expect to use it. China's State Administration of Foreign Exchange has been diversifying its reserve holdings away from United States treasuries and into gold, commodity stockpiles, and bilateral currency agreements with trading partners, a strategy that only makes sense if you are positioning for a world where the current debt structure does not hold. None of these institutions will publicly state that the global debt architecture is unsustainable. Their mandates prohibit it. Central banks exist to maintain confidence. International financial institutions exist to project stability. The moment any of them publicly questions the viability of the system's viability is immediately compromised. Their silence is not evidence of safety. It is a structural requirement of their role. The paradox of $315 trillion in global debt is not that it exists. Debt has always existed. The paradox is that nobody can coherently explain who holds the corresponding asset without eventually arriving at a circular reference, a chain of obligations that leads back to its own beginning. Follow any single thread long enough, and you arrive not at a vault of gold or a ledger of real savings, but at an entry in a database maintained by an institution that created the entry from nothing, backed by a promise from a government that can only honor the promise by creating more entries. The system is not backed by wealth. It is backed by the mutual agreement to behave as though it is backed by wealth. This agreement has held for decades. It survived the Asian financial crisis of 1997. It survived the dot-com collapse. It survived 2008. It survived a global pandemic. Each crisis required a larger intervention than the last. Each intervention added more debt to the total. Each addition made the next crisis more expensive to contain. The question is not whether $315 trillion can be repaid. It cannot. Every economist knows this. The question is whether the system can continue to roll the debt forward indefinitely, refinancing old obligations with new ones, creating money to service interest, expanding the total without ever contracting it. The answer depends entirely on whether every government, every central bank, and every major financial institution continues to cooperate in maintaining the illusion simultaneously and without interruption. A single defection, one major sovereign default, one central bank that refuses to print, one creditor nation that demands real payment instead of paper promises, would initiate a cascade that no existing mechanism is designed to contain. And the troubling observation is this: the system requires perfection. It requires every participant to act in coordinated self-interest, every single day, indefinitely, with no margin for political miscalculation, no room for geopolitical conflict to override economic logic, and no tolerance for the kind of miscommunication that historically has triggered every major financial crisis in modern history. That is not a system built on strength. That is a system balanced on the edge of a razor, held in place by the shared conviction that the razor is a floor.